This is The Bottom Line. The Bottom Line on 938 Live.
Markets went on a roller coaster ride this week with falling oil prices dragging down equities and strong U.S. economic data spiking them up again. Now, throwing in the possibility of China releasing more stimulus to bolster their economy and a batch of patchy purchasing managers index data, it looks like the year-end lull period is looking rather exciting. To help us make sense of all these, we're joined by Vasu Menon. He is Vice President of Wealth Management at OCBC Bank. Now, Vasu, markets this week were battered by falling oil prices. How should investors hunker down and ride out the storm here?
Well, declining oil prices are not necessarily bad for the stock markets because, lower oil prices could help to boost economies. But having said that, I think, oil prices are probably likely to stay weak, given what OPEC has done last week, its decision not to cut output. And also, I think going forward, the US dollar is expected to strengthen on the back of Fed rate hikes. So all of that is going to weigh on oil prices. But nevertheless, we think that oil prices could recover modestly over the next 6 to 12 months. But I think investors ought to be cautious about the energy-related stocks, the oil and gas sector at this juncture because, until the dust settles.
Now, as you mentioned, tumbling oil prices could in fact give a boost to economies which are, net importers of oil. But how do you think this will benefit Singapore?
It will benefit Singapore as well because, Singapore is also a net importer of oil. I think within Asia, most of the economies are importers of oil, net importers of oil, with the exception of Malaysia. And that's one of the reasons why the Malaysian ringgit is, has been very weak. I think here in Singapore, as long as the lower oil prices result in lower production costs, it's going to be good for companies because it means that, lower production costs means higher profits. That's good for, Singapore stocks. And, of course, the low oil prices also result in lower costs for consumers. That means that they'll have more money to spend. That could boost consumer spending. So overall, I think it's mildly positive for the Singapore economy.
Okay, what about the rumors of more stimulus from Beijing, which has driven the Shanghai market to a 7-year high this week? Does it hold water?
Well, I wouldn't put it past Beijing to undertake more stimulus. They surprised the markets with the recent rate cuts. I think clearly Beijing wants to try and keep the economy growing at about close to 7%. I think we see 7.5% this year, and I think the government is trying to achieve 7% at least next year. I think the other factor that's driving monetary policy in Beijing is also that inflation in China is running at about 1.6% compared to the government's target of 3.5%. So inflation is not at a desired level, and I think that's also worrying the Chinese government. So it's possible China may undertake further stimulus, but I don't think they will do anything like the Big Bang approach they undertook in 2008, 2009. I think they'll be more modest, moderated in their approach, but they could do more.
All right. Thank you very much. That was Vasu Menon, Vice President of Wealth Management at OCBC Bank on The Bottom Line. And The Bottom Line is brought to you by Turkish Airlines, Europe's best airline.